December 29th, 2023. It was the last trading day of the year today. So sometimes you get dramatic moves on the last days of the week because of the weekly chart, the month because of the monthly chart, or the year because of the yearly chart. And today we got a measured move down, an exact measured move from the 13 high to the 17 low. And that led us to the exact low of the day. Why the 13 high to the 17 low? Because that's a spike, right? And we end up getting a spike here, and then a lot of times you end up getting a measured move down of the spike. Had we continued to sell off, potentially we would have gotten a measured move down of this spike. But usually the first spike is a pretty big target, and it was consecutive sell climaxes, 1, 2, 3. So consecutive climaxes made a lot of sense to get out of shorts. Anyways, bar one, a bull bar closing on its high. Pretty good bar, but you're right in the middle of yesterday's range, and yesterday was a really tight trading range. Additionally, it was also a failed breakout below yesterday's range. You can see on one we tried to break out below and we failed, so we ended up getting a bull bar closing on its high. Follow through for the bulls on bar two, but it's not really what you want to see. You're in the middle of a trading range. You're around yesterday's close, which was around the middle of the day, so you really don't want anything to do with that. More follow through on three. It's a bull channel, 2 and 3. So spike 1, 2, 3, bull channel, but obviously really not a very strong trend for the bulls, and middle of a trading range, probably sellers above. Bar 4, you can see bulls not able to get through the moving average, and we get a low 1 on bar 4. Do you want to sell bar 4? Not really. You're still in the middle of a trading range, so it's really not a very good sell. And do you want to buy below there? Not really. There's probably buyers below, but it's just not a very good buy below, because we can easily test down to the open of the day pretty quickly here, or even this close. Bar 5, doji bar. You can see that the bulls who bought the close of 3, some bulls who buy the close of 3, and what they're hoping is that we were going to get an explosive breakout up and test this close pretty quickly. But they know that that was really unlikely to happen. So if they're buying that close, they're willing to scale in lower. What you can't do is buy the close of 3 and then exit below 4. Traders who bought below 3 were scaling in below 4, so that their average price was somewhere down here. And you can see during 5, they were able to get out around the close of 3 and make money on their lower entry and get out around break even on their initial entry. But doji bar on 4, so if you sold below 4, doji bar on 5, so if you sold below 4, is 5 really what you wanted to see? No, you wanted to probably honestly see something like this. 4 is a low probability trade. So if you're going to take a low probability trade, you need the type of entry bar that you want to see with low probability trades, which would be a huge bear bar. 6, a potential second leg down. So this, bulls are looking at this as a spike and then a 2-legged correction, and they want another leg up. More than likely they'll get it, but this isn't very good follow through. So more than likely, I think we're gonna continue sideways here, but we might get another bounce. But the reality is the bears who sell above this high are very likely going to make money. Follow through for the bulls on bar 7. It's a high 1 buy above 6, but a bear bar after 3 straight non-bull closes, and you're right on the moving average, so really not very good. That's why you get a big failure on 8. Traders were selling above this high, scaling in higher. 8, it's double top, bear flag with 4, potential swing short, but doesn't close very strong. A reminder that we're still in a trading range. They get some follow through on 9, but it's really not that great of follow through. And the sell wasn't that great to begin with because you're selling in the middle of a tight trading range and the bar doesn't close on its low. So there were a lot of problems with selling there. You could see 9, a bear bar, but really, again, not that big. 10, bad follow through because bears, bears are more than likely just going to scalp out and take a point rather than hold and hope we get a bigger follow through bar on, 10 or something. And that's why 10 is a bull bar. And then you get 11, and 11 is a second leg from here. And because 10 was a bull bar, traders now see 11 as a second leg. They were hoping to get some sort of bear close here and then maybe a bar, hopefully bigger than 11, but they didn't want to see this bull bar because it makes them think that 11 is a second leg trap. So what the bears who are short are doing is seeing this as a second leg, and so then they're buying back shorts at the market, and that's what's causing 12. And 12, it's a 2-legged pullback for the bulls, but you're still right in the middle of a trading range. I don't think you really want to be buying there. It's just trading range behavior. I actually I traded a practice day today. I just went on the trading the past simulator thing, and because I watched the first 6 bars of the day, and then I just turned it off because I thought there was potential that we were just going to do this all day, and I didn't really feel like sitting through that. And I turned it off and right here. And then I came back and I didn't check the day again for a while because I was working doing the practice simulator. And I came back like in here, and I was pretty surprised that we ended up moving so much. But anyways, 12 bull bar, 13 big outside down. So big failure. This is essentially a wedge. It doesn't really look like it, but 1 pullback, 2 pullback, 3, and then a reversal up on 12. But we got a big failure on 12, and so bears are looking for a measured move down to go maybe somewhere down here. I guess the first target would be here, and then the next target would be down here. 14, an inside bar, a reasonable swing short. It's early in the day. You don't know what the day is going to form like. So definitely okay to take the short below 14. And you have to keep in mind, we might get a measured move down of the trading range when you get a breakout of a trading range. The trading range is from here to here. And that's exactly pretty much where we went on 16 before the first pullback. So that's always going to be a target. But follow through for the bears on 15. So this is a reasonable swing short, looking for at least a second leg from essentially 13. And good sell to close on 15. So 3 strong bear bars, good to be selling. Big follow through on 16, climactic bar, probably going to pull back for a couple legs here. More follow through on 17, but a big tail. There are open gaps here. You can see we have with the 13 low and the 16 high. That's important. The fact that was never filled is really important. And because, the limit order bulls, they'll buy below this low expecting this breakout to fail. And you can see they were never let out at break even. So they all had to sell out at a loss. And that was what was causing a lot of this sell off. And again, the bulls who bought below 15. So they see 16. You buy below 15, you see 16. You're just trying to get out. And maybe they scaled in and they're hoping to get out at break even. And they just never were let out. And so they were trapped as well. And that led to another leg down. We had these 2 open gaps because all the trapped bulls were selling. So 18, a bull bar, big tail on the top, and then 19, another bull bar. You would expect 2 legs up, but if you think about it, it really is. It's up and down on 18. So 1 pullback and then second leg up on 19. So it's an implied pullback. So 18 and 19 functions as a 2-legged correction. And so that's when you get 20, another bear bar, and traders will start selling to close again, thinking that we're going to continue down, and we still have these open gaps, and bulls might be trapped. And you get big follow through on 21. Bulls are giving up. Good bar, good follow through. Do you sell below 21? Sure. These are all sell to close bars. You could have sold this close. It's kind of, you're going to have to sit through a pullback, but you can do it. You could sell any of these closes, really. I would be probably dragging my stop above every bar at this point. You're pretty, regardless of where you sold, if it goes above 21 at this point, so you see 21, if it trades above 21 at this point, your premise probably really isn't valid. Your premise is that it's a strong bear trend, or it's at least a bear trend of some kind. And your premise really isn't that valid if it trades above 21. So I would have my stop above 21 at this point. Big follow through on 22, but sadly a big tail on the top. And then you get inside bar 23, another strong bear bar 24. You're pretty deep in this bear trend at this point. Usually when you get sell to close moves like this or like this, they only go on for 5 or 6 bars before pulling back. You can see this was 5 bars, this was 5 bars. So usually by 5 or 6 bars, they'll pull back. It's pretty rare to see it go for like 10 or 12 bars. 25, a doji bar. And then you get 26, a good bull bar closing near its high, the best bull bar we've seen. Stop order bulls haven't made money yet today, so I really wouldn't buy, and this is such a strong sell-off. There's no reason to buy above 26, but you should definitely exit your shorts. There's probably, 50-60% chance that we're going to get, I would say probably closer to 60, but 60% chance we're going to get 2 legs sideways to up here. You get bad follow-through on 27 and then a good bull bar on 28. That could qualify as 1 pullback 2, so that could be your 2 legs. But you notice these bull bars are pretty strong. And they're closing, they're both closing on their highs. So makes you think that even if we continue down, we've probably started a trading range somewhere in here. So even if we continue down, we're probably going to pull back into this area. 29, buyers below 28, which is, expected with how strong the bull bar was. 30 is an inside bar. It's a low 2 short, 1 pullback 2. So low 2 sell below 30. It's a reasonable swing short. 31, it traps in the bull, or it traps in the bears on 30 and then, traps them in on 31 and then traps them out and then starts to go again. So it's another reasonable sell below 31. You could have been selling breakout points as well. You could have sold below 13 as it traded during 15. You could have traded sold below 16 during 21. You probably could have sold below. You're getting late in the trend at this point, but you probably could have sold below this. It's logical. Again, really late in the trend, so I probably wouldn't have sold below 26 over here because that's really late in the trend. But it's it's probably not the most illogical thing to do. Follow through for the bears on 32 and 33. Another reversal up on 34. Do bears exit at 34? I think you can. I don't really know what you're trying to gain by not exiting above 34. You have consecutive sell climaxes 1, 2, 3, and you're really deep in this trend and you just got these good bull bars. So you know we're probably in a trading range. So you don't really stand very much to gain from staying short. And then you get an outside down bar, 30, 35, but a big tail on the bottom. So disappointing for the bears. 36 doji bar, so bears not selling the close anymore. You can see that's a change, right? That's a change in the market conditions. Bears are not selling this close. And then you get a strong bull bar on 37, closing your tie. Any bears who did not exit for any reason probably have to get out above 37. And you get follow through on 38 and 39. So now you have 3 straight bull closes, and it's clearly always in long. And I thought something really important happened here. You can see the 36 high, traders sold to tick above the 36 high, and there's a gap. So if you sold the 36 high or even a tick above 36 high, you were never let out of your trade. So those traders are still trapped in. So you should be sitting here thinking, well, why are bears getting trapped on limit orders in this bear trend? Even if it's a trading range, bears should be able to get out, and they probably will be able to. When you see these, you're still thinking that we're probably going to pull back to here, but it's worth starting to take a small position here. You're probably going to have to sit through a pullback, but your premise remains valid as long as the pullback does not touch the 36 high. So 40, a bear bar, but not a strong close. Bears still not able to make money, and then you get a good bull bar on 41. So you have a micro channel now. It's 1, 2, 3, 4, 5, 6, 7 bull bar micro channel. So you have a micro channel and you have trapped bears right here. So it's definitely okay to be long buying closes here. More follow through on 43, more follow through on 44. Lots of bull bars, 9. It ended up being an 11 bull bar micro channel. So you can pretty much buy through here, though you're getting pretty high in the range here. That the traders who sell above this high, the breakout above the trading range, are probably going to be able to scale in higher and make money. And again, look here. This is a breakout point above the 41 high. Traders should be able to sell this breakout point and make money, but they get trapped. So you have traders getting trapped here. You have traders getting trapped here. So now you have 2 sets of trapped bears. So this reversal could realistically go up for a little while. The same way that this reversal or this move could go down for a little while because you had 2 sets of trap traders. This rally could be relatively successful. When you get a big bear day like this, 60% chance it's going to do this and then go sideways, 20% chance it's going to trend down all day, and 20% chance it's going to sell off and then a reversal. Today was, you could argue this was a sell-off and reversal kind of day. A lot of times it's a more dramatic reversal when you get the quote-unquote reversal. But you could argue this was a reversal, or you could argue it's when started to go somewhat sideways. But you definitely got a tradable rally here. So we got more follow-through up to 45 and a doji bar. A lot of bulls who are long are dragging their stops below any bar at this point. They know it's a 11, 12 bar micro channel at this point. So even the first reversal, bulls are probably going to buy it, especially with how steep this is. But the pullback could be pretty deep. And you start getting decently above the moving average. You can see bulls put three closes above the moving average. They weren't the best closes, but they put 2 full bull bars above the moving average. So probably going to go higher even if we pull back. You can see where did the 45 high touch, right? Well, I was talking about breakout points. This low, this low, this low. They're all breakout points, and this is the breakout point, the 16 low that the market was targeting. And that was a reasonable place to go because that was where traders who bought below bulls got trapped. And so you have trapped bulls trying to get out around break even during 45, and that's what happened there. Some traders exit below 45, and that's causing the big bear bar 46. But with how strong this is, we're probably going to get another leg up. 47, 48. So 3 straight bear bars, an inside bar 48. It's a high one for the bulls, but bear bars are not that great. I think that, 3 bear bars is more than you'd want to see. So it's alerting you that, we might get a channel, but it's not going to be all that good. And one of the reasons is you got to think about it. Like with how strong this is, you got to keep in mind that the bull move is probably not going to be all that strong. And additionally, if you look at this bull move, you should look at it, there are tails on everything. There's conspicuous tails everywhere. So it's really not the strongest bull move in the world, even though it went up pretty quickly. So 49, a bull bar, but a big tail on the top. Big bull bar on 50, but really not all that great to buy. You're buying pretty high in what's probably a developing trading range. Sellers above the high of the day, 51. More follow through for the bulls on 52. So 4 straight bull bars, probably going to be a second leg. But with these 3 bear bars, you have to be thinking that we're probably in the channel phase. And in the channel phase, traders sell new highs, not buy them. Thinking about over here, traders were selling new lows, right? They were selling the new low because they're selling, the breakout point. They're selling the low. They're selling the breakout point. They're selling the breakout points. Versus in a channel, in a bull channel, traders will sell the breakout points. And in a bear channel, traders will buy the breakout points. And they're looking, in a bull channel, traders are looking to buy pullbacks, not new highs, because it's weaker. So you get 53, a bear bar, but this is probably a bull channel, and this is too many bull bars to trade against. So bad follow through 54, 55, bad follow through for bulls who were buying about 54, a high 1, 56, an inside bar. Essentially, you can argue it's a low 2, but I'm not taking that. It's way too small, and we're in a bull channel. More bad follow through on 57, a bull bar on 58, and then we get a new high on 59. But what are traders doing at the new high? They're selling. They're selling at the new high. They're buying, limit order pullbacks. So limit order pullback 60, 61, another bull bar, pretty high in the range. Again, maybe an okay buy, but when you get to this new high, what do you think is going to happen? Right? We end up getting a tight channel up to the new high, and then a big sell off. And when you get this, what are traders doing? What do they do? You get, bear bar, buying, bear bar, buying. So every single bear bar so far. So especially, this wasn't part of the channel yet. You could argue it's part of the channel, but you got bad follow through here, but you got big bear bar, immediate bull bar, big bear bar, immediate bull bar. So what do you think is going to happen on 67? Do you think 68 is going to be a big bear bar closing near its low? Probably not. It's probably going to be a bull bar. And so traders know that, and so they're buying below it, and that's what's causing the big bull bar on 68. Bad follow through on 69. We're testing this close, and we're basically right at the top of what's probably a developing trading range. You could argue the trading range started here, and this was just a leg in a trading range, and this is also a leg in a trading range. 70, bad follow through, obviously because traders are selling out of their longs. And then 71, probably no one's selling below 70, so traders buy. They'll buy more lower. 72, a bull bar, but not all that good. Top of a trading range, top of the channel, not really great. 73, a bear bar, closing near its low. It's probably too late to be selling, and this is kind of a lottery ticket trade. So, you're hoping that we just get a big collapse and a second leg down from here, but it's just not all that likely. And then you get 75, 76, and 77. Bears trying to get a sell to close finish. But the reality is they're just letting bears out. This is just relieving a lot of the trapped bears. And there's big tail on 75, big tail on 76, huge tail on 77. So there's a lot of problems with this sell-off, and it's looking more like a leg in a trading range. And it ends up just going down to the 48 close, around the 48 close, where there's 3 straight bear bars. So theoretically okay to sell to close. Not great, but theoretically okay. And this is the bottom of the channel. And when you're in when you're in a channel, a lot of times the bottom of the channel gets tested. When you're in a bull channel, a lot of times the bottom of the channel gets tested. When you're in a bear channel, a lot of times the top of the channel gets tested. And so it wasn't unreasonable to think we were going to get down here. And then traders immediately took profits. And risk happens fast in trading ranges. And this is a prime example of it with a 14-point bar. So if you were short, if you were short here or here, you were thinking you were about to make a lot of money, and then suddenly you're at a loss. And that happens. Daily chart, pullback. We can go sideways to down to the moving average. I think this started a trading range. So I think we're going to form a trading range within this range, maybe all the way down here. But I think for a little while, we're going to oscillate basically within this. And then maybe set up some sort of major trend reversal. But even if we get it, we would have to go sideways for probably 50, 60 bars in order to, this bull move still has so much influence over the market right now. So we would have to go sideways. We're going to have to go sideways for quite a while to let the influence from the bulls wear off before we go down more, or even before we get a second leg up. you could argue this whole thing is some big wedge. So generally the corrections are about half as many bars. You got 36 bars. This was really extreme though. I think we're going to need more than 18 bars before we get a second leg up. I think we'll need more like 20 or 30. Yeah, that's really it for the day.